Hello, ladies and gentlemen. Welcome to today's webinar. I'm Joseph Novichkov, Senior Trading Manager with GDM. Today's session, ladies and gentlemen, will be the final session with our September webinars. It is quite interesting for a few reasons. First, because of the significance and the simply the importance of the patterns today that we will be looking at. Second of all, it is because it's the final Friday of the month, which means we have GDP report for US. Therefore, in about 28 minutes, we will have a look at the economic calendar. We will talk a little bit about the numbers that are coming out, what they actually mean and what we can take out from it so we can apply into our trading. So without losing too much time, the first patterns that we will start today will be channel patterns. Simply here in front of you, you see the two main trending channels, which will be the down channel and the up channel. So in the explanation that I will bring you right now, pretty much I'm mixing all together because it all applies one and the same for both channels, whether it's down sloping or up sloping. So a price channel actually is a continuation pattern that slopes, as I mentioned, up or down and is bound by an upper and lower trend line. The upper trend line marks the resistance, and the lower, of course, marks the support level. Price channels, however, with negative slopes, which are down channels, the one that you see on the left side, are considered to be bearish, and those with positive slopes, the one that you see on the right side, are considered to be bullish. Of course, if we have to refer in, with a different purpose, a bullish price channel will refer to a channel with positive slopes, and of course, bearish price channel to a channel with negative slopes, or sometimes down channel or up channel. This would be pretty much the easiest way to distinguish between both. Of course, there is a third type of a channel. This is the sideways channel or sideways direction. Also, it's known as a rectangular pattern. We spoke about it a couple of times in our previous sessions. I'm not mentioning it into our patterns at all for a very simple reason. It's pretty much because we're focusing on directional trends, positive and negative trends. So the main trend line, the one that you see, whether it's down channel, which will be the one above, and up channel, the one that will be below, takes at least 2 points to draw the main trend line. This line sets the tone for trend and the slope itself. For a bullish price channel, the main trend line extends up, and at least two reactions, which are two reaction lows, are required to draw that particular line. For a bearish price channel, however, the one on the left, the main trend line extends down, and at least two reaction highs are required to draw it. Now, there are various of channels, so to speak, in the MetaTrader 4 platform that you can directly use to create two trend lines, one above and one below. One of it is called the equidistant channel. There are many others, which I'm not going to mention, basically because for those that would like to use only trend lines, you can just use a singular trend line to draw this channel line or the main trend line, and of course guide yourself along the way. Sometimes, let me mention that the channels that you will see will not really have a perfect shape. So most of the time you might see fluctuations above and below. Those are the fake breakouts that we will talk about in a few minutes after we mention a few other things for the, let's say, for the bullish price channel. So as long as the price advances and it trades within the channel, the trend is considered to be bullish. The perfect bullish trend, some of you might know, is a 45-degree angle. 45-degree angle trend or a channel is the most sustainable trend. Bearish price channel, however, also as long as the price declines and trades within the channel, the trend is also considered bearish, and the degree, which is also 45, or should I say minus 45 in this case, is also valid. I'm saying minus 45 because if you just draw the XYZ diagram, you will see that below the zero level you have minus 10, 15, 20, 45 degrees. So scaling, even though it is a matter of personal preference, trend lines seem to match reaction highs and lows best when they're so-called semi-log scales. Okay, semi-log scales reflect price movements in percentage terms. A move from 50 to 100, for example, will appear the same distance as a move from 100 to 200. As of course, in a bullish price channel, some of the market participants will look to buy when the price reaches main trend line support. It's the one on the right side, so you can guide yourself. The main trend line. Every time the price hits the main trend line, all traders start to place their long positions. Vice versa, it's for the bearish trend and the bearish channel pattern. Every time the price reaches a lower high, let's say, hitting the main trend line, all traders and market participants will look to short the instrument at hand. Simply because, ladies and gentlemen, technical analysis is just as much, let's say, art as it is also a science. There is also a room for flexibility. So, the things we mentioned about 5 minutes ago, even though exact trend line touches are ideal, it is up to each individual to judge the relevance and, of course, placement of both the main trend line and the channel line. By the same way, of course, the channel line that is exactly parallel to the main trend is also ideal. But as we mentioned, price fluctuations, like in most cases, shadows above the main trend line on the bearish trend, for example, if you take a look at on the left side, fluctuations, maybe sometimes even price closures on the upper side of this main trend line will occur. But in the next session, the price action will drive the instrument at hand below the main trend line, keeping the validation of this channel pattern. Now, there is nothing much more to say about the channel patterns except that they're extremely easy to trade. They're appearing on our charts every now and then. Like maybe you might be able to catch a few channel patterns on one day, depending on the time frame, of course, that you're looking at. Let's say a 15-minute chart or 30-minute chart. You might even catch a few different trends, one downtrend, then another uptrend, and of course 2 individual channel patterns. This is something that we're looking at this moment on the gold chart. If you have more than one monitor, you will see that on a 30-minute chart, 1-hour chart, 15-minute chart, we have a down channel or bearish channel, and the price is sloping down, continuing. Of course, we're expecting further decline below the 1137 support level, but this will need additional volume, and as we can see that the volatility is picking up slightly on our ADX on the platform, and of course for such a volatility to continue, larger volume is likely to occur in about 17 to 18 minutes time prior to news release. So we might be able to see price change with about 5 to 7 up to $10 in a matter of minutes. For your information, it's always very good to observe commodities, especially on major news from US. Let's take a look at our next pattern here. This will be the rounding bottom and of course rounding top. I've placed them in one sheet here in front of you so you can see both with their mirror images, which are of course long-term reversal patterns. They're best suited for weekly charts. Some of course might use them on daily charts. However, on more volatile instruments, it's also good to note that daily charts can be reversed within a matter of next day or the day after. So in a couple of sessions you might be able to see a reversal. Weekly charts, however, are extremely powerful, and if you have noticed that already, you will of course be on the same page with me from the perspective of using the rounding top and bottoms. And the significance is the prior trend. In order to be a reversal pattern, there must be a prior trend to reverse. Ideally, of course, the low of the rounding bottom, for example, the one on the left side, will mark a new low or reaction low. In practice, however, there are occasions when the low is recorded or spotted many weeks earlier, or months probably. If we're looking at the weekly chart, that would be in a matter of months. The instrument at hand would be pretty much trading flat, forming that particular bottom of this pattern. This decline, however, ladies and gentlemen, can take on different forms. This is where you should either write this down or make everything sure to remember, is that some of these patterns, let's say, are not so oval as the way that you see those in front of you right now. So there could be a rounding bottom, for example, that can resemble a letter V, which is also a bottom, and it's also called rounding bottom. But of course, should not be too sharp. That's very important. So sideways direction on the bottom of this pattern should occur in order for it to be valid. Also, different shapes that can occur are with the letter U. The one that you see in front of you is a perfect hemisphere. This is how it would actually resemble if we're if of course we live and trade in a fair in different worlds, which should be perfect in all ways. That's how our patterns would look. However, that's not the case for the past 15 years. Long ago, the patterns that I'm presenting to you on each page, each seminar, are those with the most perfect shape, but in time, with experience, you will train your eye to see those patterns, their shapes, their price targets, significance on the market, so on and so forth. Breakouts. Let's talk about breakouts. Bullish, for example, confirmation comes when the pattern breaks above a reaction high. That, of course, the market is beginning to from a decline at the start of that pattern. So have a look at this decline here. It is very significant. This is how the pattern starts to confirm. So basically it faces a strong resistance level, pretty much from where it actually started to form. And then on the breakouts, on the second session, it is also very good to join in the market with whatever you seem fit. Another thing about price objectives here in this case, if the prior trend was, let's say, somewhere here, in that case, we could expect 100% from the forming of this pattern to the top of this trend, or to the beginning of the trend itself. And we can expect, let's say, approximately the same move, which makes the rounding bottom or the rounding top a symmetrical pattern. Volumes are also extremely important indication of confirmation of these patterns. For example, on the breakout, so here is the part where I would mention this for all the patterns that we've spoke about, for those that we will talk until the end of the session as well. Volume is an important indicator on your MetaTrader 4, ladies and gentlemen. On a breakout, every single pattern should have high volume. This is how you will guarantee yourself a continuation. So, the next pattern that we will talk about, you will see that is pretty much the same as this one, with a very single difference, that it more shapes of, let's say, a teacup. You can see that there is a rounding bottom here as well on this teacup, or you know, you might even find it somewhere on the web as a cup and a handle. However, I can't really say which name came first, whether it's teacup or cup with a handle. It's all the same, and it's a continuation pattern, so it's always the way that you're looking at it. It doesn't have any other shape. It's not a reversal one. The teacup is a bullish continuation pattern. It marks a consolidation period followed by a breakout. Of course, the cup forms after an advance, and of course looks like something like a bowl, or as we mentioned, a rounding bottom. As the cup is completed, a trading range develops on the right hand, which means when you take a look, a range should start developing on the right side, and then the handle is formed, the way that you see the breakout line here, or also called neckline, and the handle itself, a slightly sloping down market, followed by a sharp volume move, breaking out from the resistance level, which of course it's not necessary to be with the same price as this previous here, from where of course the pattern started to develop. Let's talk about the trend. As we can see, with all directional trends and the patterns that we include in it, the trend plays a very significant role, because to qualify as a continuation pattern, a prior trend should also exist. It should not be a sideways direction, because then it's probably something else. Ideally, of course, let's talk about ideas, ideal worlds. The trend should be a few weeks old, or if you're looking at a small time frames, let's say a few days old. This gives a market time and the price to mature. So basically, if you have missed the opportunity and you are seeing that if a pattern of this sort is going to develop on our charts, you better wait for that particular breakout so you can see whether this is a continuation pattern. Also, let's mention here that the cup and its shape here are very important. It is usually considered to be a U shape. Of course, it could be also a type of a hemisphere, but of course it could also be a V shape. Now, why is actually called a teacup or a cup with a handle? It's very close to your mind probably to distinguish that a V shape could be, let's say, a coffee cup. Hemisphere could be a teacup. You name it. The perfect pattern, ladies and gentlemen, would have equal highs on both sides of the cup. But this is not always the case, as we mentioned. So what do we mean by equal sides? The sides between the lower low and the previous high from here to here should equal the distance from the lower low to the new high. However, it could be smaller or larger in size. It's still one and the same pattern. You cannot expect every position to be at the exact price, because in the open book there are prices that are getting filled. So at the moment of the creation of the handle, a price could be slightly different, and then of course the shadow could be prolonged, or it could be shorter, or there could be no shadow at all, which makes the right side slightly lower than left. Before we move to the next extremely significant, very important chart pattern, I would like to turn my attention to the depth of the cup itself. Also, ideally, the depth of the cup should be, let's say, 1/3 retracement or less of the previous advance. So what do we mean by that? If we're using a Fibonacci retracement from here to the end of the trend, okay, well, let's say it's not the end, but the first retracement level, the lower low should be at least 33%. This is in ideal world. Now, with volatile markets, and of course, over the time of the reaction of the price, depending on the time frame that you're looking at, the retracement could range from 33% to 50%. In extreme situations, the maximum retracement could be 2/3, which is somewhere around 78.6%, which of course confirms with the Dow theory of the trend. And what it is, it's more likely to continue instead of reverse. So for those that have no idea why I'm talking in percentages, well, it is much easier for you to use a Fibonacci retracement, and just remember the numbers of the Fibonacci where you have to wait for a retracement of this a particular pattern to create its depth, instead of just measuring what is the pip size from here to here divided on 3 and just find out where it actually has to go. If you just draw the line with the Fibonacci from 0 to 100, you will see exactly where your 31.8 or 33% lies. I'm pretty much used to with 33% to 68.6. And why is that? We will find out in the next pattern, which is, of course, the Gartley pattern. Some of you might know it as a bat pattern. Some of you might know it as a butterfly. All of these names are absolutely with no meaning. But of course, the only name that comes is from the person that actually created it, or let's say discovered it on the charts, Mr. Gartley, first described on his book from 1935, Profits in the Stock Market. Now, that's a long time ago. So you can see that those particular near 80 different chart patterns, nowadays there are more than 100. We're actually using a handful of these because most of them are occurring, let's say, in a matter of 10 years, 20 years, and most of us will not be for so long on the market. So it's been known for us to use about 20 up to 30 chart patterns, which we can see on the charts every day. However, before continuing, we should also note about the Fibonacci retracement. Now, why did I mention those levels of the Fibonacci? As you can see here, I've directly placed in front of you to see the correct levels for the Gartley pattern to measure, and how this measures what are the proportions, what are the retracements, and how we can identify it, and where to confirm, and of course where to buy or to short. We will find out in a few minutes. But of course, the most important part comes from the customized levels of the Fibonacci. Here we have 38.2, the 78.6, the 127. Now those three levels are those that doesn't come with the default settings of the Fibonacci retracement tool. You can set them very easily. I'm not going to go too deep in this. We have precisely the method of adjusting Fibonacci levels and any other tools in the MetaTrader 4 if you just go to our YouTube channel and find Intro to MT4. So this chart here in front of you, ladies and gentlemen, demonstrates a bullish Gartley pattern. And of course, the price rises sharply from the point X here. Now, those points have been known to be used, of course, X, A, B, C, D. Surely you can use anything you like, 1, 2, 3, 4, 5, whatever is easier for you to remember. This is the longest leg of the pattern. XA is the longest. However, AB sees the price changing direction and of course retraces back down part of the distance that it's covered by the XA leg. In the pattern's purest form, let's say in ideal world, one more time, it will make 61.8% retracement on the Fibonacci of course, the XA leg. This is very important to remember. Now, before we continue, I would like to turn attention here to all of you. Let's have a brief look at the calendar today, what the market is going to offer us. I'm quite curious to find out what GDP actually is. Well, as expected, of course, I've anticipated higher GDP, neutral to higher, as one more time is a hint for those that have no idea what I'm talking about. And gold price, ladies and gentlemen, is very, very sensitive to this data. So basically, when you see the price, the market pricing in, it starts a couple hours, even from the morning sometimes. So therefore, you can anticipate what the numbers might be. If you see moderate volatility, you might be expecting some neutral numbers. If you're expecting high volatility, depending of course on the direction of the gold price, you can determine whether it's going to be positive or negative. And I'm very happy to see some good numbers for US, because the anticipation and of course the projections that I made this morning for the team here, we shorted gold at 1147 this morning after it broke down below the 21 exponential moving average. And of course, it's keeping the downside for projections. If you are keen to understand or to find out if you have any positions or you like to open, we're looking to do something like 1135 for first target. For some conservative reasons, you might consider 1138, 37, and of course, final target at 1129. Still, it's Friday. We might even see even lower prices due to profit taking, followed, of course, with sharp move up on this particular profit taking. Getting back to our Gartley pattern, and of course, let's get back to the presentation material which we have. There we go. Moving to the B and C leg, but before that, let's repeat one more time what we've been talking about. The XA leg is the longest leg of the Gartley pattern. The AB leg should retrace at least 61.8% in ideal world, of course. The BC leg, however, the price changes direction again and moves back up to point A, for example, retracing somewhere around 38.2 to let's say 88.6. For example, I didn't particularly set this level of 88.6 because I already have the 78.6, which plays the same role almost. And we don't really expect to see a perfect pattern with supporting and resisting on levels like 68.8 or 78.6. So we just need something approximate, but the higher importance carries the final leg, which is the CD leg, and as I mentioned, the most important part of this pattern. As of course, it is important for you guys to remember that AB leg equals in distance to the CD leg. So the pattern that you're looking at has a structure AB equals CD to complete the pattern itself. And of course, looking to enter at point D. So what do you see here? You see something looking like probably head and shoulders, probably double top, but it's nothing or something in between. Well, for those that are actually getting familiar with the Gartley pattern for the first time, this is a beautiful formation that has high success rate, let's say high profit ratio, and in most cases it's with, let's say, lower risk ratio as well. It has, if it reaches a target of 127 on the BC leg or the 78.6 on the XA leg, for example, to form the D point, this holds greater significance to the upside that we need. So let's take this one more time and explain it in details. The difference when trading, ladies and gentlemen, the Gartley pattern is that you look to place your entry points at the point where the CD leg has achieved a 78.6%, somewhere here. Now, of course, it's important how you set your Fibonacci, whether it's Ray or it's a default setting, that it actually creates it to the particular date that you've opened your chart, and from then on, it's just going to stay behind. Sometimes it's better to look at it like this because the levels are not getting mixed up and it's much easier to calculate those distances. This is easier to see, of course, and it means that you can simply draw a Fibonacci retracement using the XA leg and then use the 78.6 retracement level to enter as a price level, of course. Important, very, very important about our D point here. We're not living in a perfect world. One more time. So, to be exactly the same as 78.6% retracement for a point D is close to, let's say, 0.001%. So sometimes it stays above, sometimes comes even lower, but in most cases, the ideal D point should also represent something between 127% to 161.8%, the extension of the BC leg. So what I mean is when you measure the distance and you get your levels, the D level here, the D point, can come down to 127 or 161.8. But it is very important to remember that your D leg should not extend below the X point or the 100%, the distance between XA. This is when your pattern gets invalidated. So, let's set some rules. If you wish to write down along with me, before we try to trade this pattern, we have to make sure to know the rules. The AB leg equals the CD leg. 78.6 Fibonacci retracement of the XA leg is necessary to confirm our D point, or a 127 to 161%, 161.8 for the extension of the BC to create your entry, which is actually the D point. And why am I saying that the 100 retracement on the XA leg is important to stay intact? It's simply because a few pips below it, you will set your stop loss for protection of your own investment. It is very easy to see that, and I'll tell you where. If you open your gold charts and switch on a daily chart, you will see a bearish Gartley pattern. However, as I mentioned, to see ideal D point entry, we need to see the price at 11.80, which is roughly $40 higher. But we saw prices close to 11.55, very close to our 78.6%, between 61.8 and 78.6. So that means that if you have smaller number than 78.6 or higher number than 100 of the XA, that means less reliable your pattern is. But this is a test result you might be able to use just to see how a bearish Gartley pattern looks like, and it's just a mirror image. It's reversed upside down to this one. So the importance here, why I mentioned that it might resemble sometimes as a head and shoulders or double top, or between double top and double bottom and head and shoulders, is because both patterns, head and shoulders and double top, are bearish reversals, and the way the Gartley looks like is actually a bullish reversal or a continuation pattern. So it's vice versa. And it's very important to get closely familiar with this pattern, because then those patterns such as head and shoulders, reverse head and shoulders, double tops and double bottoms will not play bad role when you enter a position and then your market reverses against you and loses your money, and you start asking yourself, why is that pattern not working? That's why you have to get familiar with more and more patterns. But for now, those that I've presented up till this point are the most significant. And of course, they're pretty much appearing on the chart every week, depending on the time frame, every month, and the price objective is within reach between 5 to 1,000 pips in near term. But that, of course, depends on the volatile unit that you're trading, depends on market conditions, and everything that we're facing each day. Well, that's all for today, ladies and gentlemen. Thank you very much that you've joined me on our last seminar for this month. I have yet not made the new topics for next month, but I will be ready with them next week, hopefully before the end of the month, so we can publish them in our website, and then you can just go ahead and sign up, absolutely for free, of course. And of course, you can expect always something new, something interesting. And also, one more time, thank you very much for the questions. And for those that joined us a bit later today, please remember the webinar is recorded. You can always review it from next Tuesday. It will be uploaded in our YouTube channel. And if you cannot find it, just go on our website, call us directly on the phone, or use the support department chat to get what you need. Thank you very much for being here. I'll see you next month. Bye-bye.